All right, big picture for the stock market with a little review for 2024. When we came into 2023, I was questioning if the low was made in the market. I had talked about that I thought that there was about a 50-50 chance that we had seen the lows. Though when I looked at the Dow, I said, well, that, was almost certain that the low was in for the market and we were going to have a bull market year in 2023. I wasn't sure whether the low we expected to come in March was going to test the lows that we had seen or not. Turns out that really I was far too pessimistic. I thought that the S&P 500 would, on the outside, get to 4,400, really looking for 4,300 or around 4,360. It was, of course, much stronger than that. The AI stocks drove the Nasdaq and the indexes to the upside, with all-time highs scored by the Nasdaq and the Dow. The S&P 500 missed it by a little bit, and the Russell much, much weaker, as those small caps suffered a lot earlier in the year. So I thought there would be small gains for the year for 2023. There were actually large gains. Take a look at this video just so you can see what I said about the Dow earlier in the year.
On the Dow, this looks to me very clearly like the bear market low is in place. And the rally that we expect to come into the third to fourth quarter of the year is very likely to get it up to all-time highs. So the upside targets for the Dow Jones into that period of this of the first leg on the upside in this bull market would be about 38,000 there to 40,700 on the upside. The probabilities of making it to the all-time high, which is up there near 37,000, that's that level right over there, is extremely high. The probabilities of exceeding that is better than 70%.
So the stock market for 24, the question that I've gotten from tons of people, is it still a secular bear market? Well, people are writing to me, how could it be a bear market if it's making new highs? Well, the truth is it can still be a secular bear market, and I'm going to show you what my projections are in the market, and you will see. So I'll show you some slides in here and some graphics, and you'll get an idea of what I'm looking for and why I think it's still a secular bear market, even though the market has challenged the highs. As I said in the opening of the show, I believe that the stock market still has time on the upside, and based on this analysis, that will not change, but the upside is limited, and I'm going to show you a lot of things in here that I think are going to be supportive of that. Let's take a look here as we look at this slide. So this slide is showing you the Dow Jones Industrial Average from 2007 to 1942, essentially. And in there was a bull market that you can see from that banking crisis in 1907 all the way up through that peak that we know in 1929. And this was a 22-year rising bull market, secular bull market. There were lots of things in here where there were declines, World War II, the Forgotten Depression right in here, 2021, where the government did nothing as the economy went into a depression, and James Grant has a book about that. And then we got into a period where there was a massive expansion, and the market roared up here, gaining 728% off of that 1907 low. So that was 22 years that it moved up. And this is the secular bull market. This is the secular bear market right over here that you can see as the market moved down very, very sharply in here. And there was this huge move to the downside, a 50% gain. That was a pretty short bull in there when you look at that, only about 6 months, and then this long bear market. So you had a bear market, bear market, bear market, bear market. Yeah, there were 6 bear markets during this period right over here as we got into World War II. So the market really was extremely wild during those periods, and you can see that there were a lot of bear markets during that until it finally made its low. 13 years of correction in there with 6 bear markets. You can see, so that's your secular bull and secular bear during that period. 13-year correction after a 22-year rally. Take a look at this now, which is looking at the post-war boom, post the World War II and the post-war boom into 1982. And what did we have in here? Well, we had a 24-year bull market. This is your secular bull market in here. And this was really fed by the huge savings that occurred during World War II. People buying all those war bonds and all the soldiers getting paid while they were fighting the war. And sadly, the spouses of those that were receiving money that did not make it back. And all that money spent here in the 50s and all the way up through here. Now, you could see that what happened was that the rally in there was about 929%. It was absolutely massive. That lasted 24 years. And then we got into the corrective period, the secular bear market. I want you to see, in this secular bear market, there were 1, 2, 3, 4, 5 bear markets in there during that period. Actually, you could see here in May of 74 is when I became a trader in the CBOE. So I actually traded this decline, this bull market, and then all of these bull and bear markets right over here. Traded all of those on the floor of the CBOE. And you can see in here, that's what happens during a secular correction. Right in here, and that secular correction was about 16 years. It went to around 1982. Secular bull right in here, secular bear right in here. Now, this right in here, this shape that you see right there, that actually looks a lot like what we've done so far in this bear market that we had into last year, and then the bull market that we have going on right now. And I want you to note that this advance actually made a higher peak than this one did over here. So for those of you that are questioning, can you have a secular bear at a time when you're making higher highs? Well, absolutely, yes, you can. It usually would not make a significant higher high. And this is about 5 or 6% above what this high was over here. So that's important to discuss because I'm going to talk about that in a few minutes when I look at some of the other charts. So that's a look there at the secular bull, secular bear, looking at that period. That was a total of around 40 years, just as the previous one was, as we looked at the 1907 to the 1942 period. So that's secular bear, secular bull, secular bear, right? Okay, so now we'll move on and let's look at where we are right now. Well, what do we have in here? We have a period of 23 years, the rally less than the other ones, 523%. That's from this 22 bottom over here where we had the dot-com bust. And then the market rallying all the way here. Great financial crisis was about the same low as you had over there, a little bit lower. And then this long bullish period in here. 23 years, it's pretty much like we had in the previous two secular bull markets that I'm talking about. And the expectation is 13 to 16 years more with huge ranges. That ends around 2035. And it's likely to have 4 or 5 bear markets more in there. Remember, I showed you the last one where I said 1966, 1968, 1970. That was the same shape that we had back over there. And you can see that the Dow Jones Industrial Average is making a higher high. And, of course, we anticipated it would get to close to 38,000 for that year and for last year. And, well, it got to 37,689. So that was a really nice rebound. We're a very powerful period in here, and I believe still in the secular bear market. So important to see that when you look at that there certainly could be this long period of correction. And when you look at the GDP, well, take a look here. This market cap to GDP in the 2001 peak was 141%. The market cap to GDP in the 2007 peak was 105%. This was crazy as the government overstimulated everything in the everything bubble, which is still continuing, and it got to 197% right over there, and now coming back up to 180% of GDP right there, as the GDP did grow, of course, so that made a little room, but still historic valuation when you look at that. That's why I believe that of that lose that I talked about for the stock market, well, valuations is certainly one of them, and certainly stimulated by the AI craze. So let's look at some more things that I think are important. Is AI lifted the indexes to near historic levels, and a huge concentration is very likely to get corrected. Let's take a look here. This is was put out by Guardian Graphic. You can see all of the sources that this came from down over here, looking at what they call the Super 7 portfolio: Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta. I would tell you that the AI stocks are different than that. And I think that Meta will be one of the giant losers for the stock market next year. Tesla probably also. And there are other stocks in there that I think are much better for AI. And we'll talk about that later in the year. But I think Tesla's going to do poorly. And I think Meta may be one of the worst stocks of the year going forward. Let's take a look. You could see the super portfolio in here. Look at these gains that it had over there. And this is the non-super companies. And you get a very clear look at how they did not do very well. I've showed similar charts when you look at the MAG 7 versus the non-MAG 493 in the S&P 500. It looks very much like this, 70% gains versus 12% gains. When you look at that variation. So that is important, but not all tech stocks did all that well. I just have to show this chart because this is ARK Innovation ETF, and this is where she made her peak over here when you look at that way out in 2022, and you had this bear market, of course, and look how crummy that this ETF did here in 2023, from this point here to this point here. I mean, that was just absolutely awful. And you could see the cycle patterns in here are actually very clear, and now in a rising phase and doing better, getting above that level. So positive, certainly, but not all tech stocks did well. Certainly, it was just really those in AI, and the ARK Innovation did a poor job as far as investing in things that were not in those hot stocks. And this just shows you that, you know, a good example of how in the tech category, the concentration is so much in AI. I thought that was really very, very important to show you. So that's a look at just some background in here for the stock market before we get into this analysis, as we're going to look at the stock market for 2024. I want to start with a chart that I think is very important. I started the show by telling you that I thought that the implied volatility or volatility in all the markets was going to be pretty high. Now, I showed you that I thought that the metals markets were going to move up significantly, and I think money is certainly going to move into there, maybe as it moves out of the stock market. But if money's going to be moving out of the stock market, then that means implied volatilities are going to be going up. So that means I have to prove to you that implied volatilities are likely to be going up. Well, I'm going to do that right now. Look at this magnificent chart. This is the VIX monthly, so it's implied volatilities. Remember that VIX is a reflection of the desire for institutions or big traders to buy insurance. In other words, if they want to buy puts, if they have to insure their positions, then that means that they're going to pay more for puts. So it's a reflection of the price of puts is what it really is, or the demand for puts. When markets go down, when there's a big demand for puts, VIX goes up. I mean, it doesn't get clearer than that. Here you can see, wow, look at these just absolutely beautiful cycle patterns that you see in here. You can see those rhythms as, the markets were very weak in the 2001, 2002 area, and implied volatilities were up. You could see how that went through that, certainly, and through 2007, 2008, these big jumps in implied volatility as the market got weak. And look where we are right over here. These cycles are ending. What does that tell you? There are years of increased implied volatilities ahead. And that first cycle, that first move that you see over here, which, this is a few years, each one of these is a few years, gets you these big jumps in implied volatilities. This one early on got up to 30. This one early on also got up to about 35. This one early on gets up to about 38. This one early on gets up to about 48. This one early on gets up to 39. You can expect 35 to 40 implied volatilities to be coming out in here. That's my first chart that I'm going to show you, which essentially says that we're very likely to see higher implied volatilities for coming years, and that means there's going to be a number of big downside moves in the stock market, and just great visual that you see here about how money flows in and flows out and how that causes demand for puts as volatility goes up. And that is about to start. There's still time, of course. We don't know exactly when that bottom is going to come in implied volatility, but I wouldn't be surprised if it wasn't very soon. So that's an important look at the VIX, which is, I think, something that we have to be very cognizant of, that something is changing. So now let's leave the VIX and let's take a look here as we look at the monthly chart of SPX. Now, this chart is very telling because I've got a lot of projections in there. Remember, I'm expecting that we are in a period of extremely high valuations and coming volatility, and that we are still in a rising period of a cyclical bull market that living in a secular bear market. You can see the cycles in here. I made the bottoms. I have the bottoms highlighted, the troughs a little differently. When 3 cycles are coming down, there are 3 stars. When 2 cycles are coming down, there are 2 stars. And you can see that. And right over here, coming into the middle of this year, there's 1 star because there's only a minor cycle coming down. That would say that there is likely going to be a pullback in here. Now, I talked about interest rates going up, and I talked about that I thought that there was going to be a move in the 10 years that take it back up to about maybe 4.4, 4.5. I have that listed right over here. Your intermediate trough that we're looking at right over here sinks in April, so that would be what we see on the weekly chart. And that's why we're looking for this pullback in here. We think interest rates are going to get a bump to the upside, and the stock market is going to get a pullback right over here. The minor trough that we're looking for looks like it times into this timing range here. And the targets are 44.80 to 42.90. That's this 23.6% right over there. That is a very optimistic call for that to be, and it's more likely that the pullback in here is to about the 42.90 area right there sometime in the second quarter of this year. But, this is just a minor cycle right over here, and that is likely to be followed by more rally. So we're actually looking for the bull market to continue out over here into late 24 and maybe even into 25. Still, we're concerned about valuations, and also the fact that if you look back at that period in from 66 to 75, there was a higher level that the market achieved by about 5 or 6%. This level right over here, which is 5% above the all-time high, would be 190% of GDP. So that's this level right over here, which is about 5,050 right there. That, is a pretty reasonable upside target for late in the year or beginning of next year. You can see in here there are some fib extensions in here. There's a dominant 50 and there's a minor 100 right there. These come in around 5,000. So all of these levels right over here, about 5,000 up to about 5,100, are a very big resistance area, represent 190% of GDP, and would be an all-time high, like 1972, of about 5% over the previous high. I make this as a best case for this cyclical bull market that we have in here, with the highs likely coming towards the end of the year or into 2025, with a likely sharp dip in the middle of the year. So again, we're looking for a decline likely to this area of around 42.80. It could get support at 44.80-ish right there, and then moving up and making a high in the area of around 5,000 sometime late year or the beginning of next year. Then you can see the bear markets right in here, as we think that this intermediate decline in here will be, like we saw in the 1970s, a significant bear market where it comes down pretty significantly. It could be anywhere giving up to 25 to 40%. This target over here, which is the major 38.2% from that wild 666 low, that would be a reasonable target down there. But, now we're talking about 2026 out over here. So that's probably too far to look at, except that if you watch my gold, if you watch my analysis on gold, this is the time frame that I think there's a pretty good chance that gold and the S&P 500 cross at around 3,200. If I'm off on that, then it's way out over here in 2029, 2030 that this will happen, or before that. But that's my big call, a bold call for maybe this whole video, is that the S&P 500 and gold price will cross. I'm guessing it's around 3,200 where that will happen. And some people will write me and say, wow, Slim, that makes sense based on all the analysis. And some people will write me and say I'm nuts. Anyway, wanted to show that to you. But for this year, we're looking only at this time frame right over here. And that says to us a decline, getting support probably at that 38.2% right over here. We'll call it 42.90. And then moving up here and getting near 5,000. The chances of having that move to 5,000 earlier in the year, you can see, is really small. When we look at that, it's much better, much more likely that that will happen out over here in Q3 or potentially Q4 right there, or even Q1 of 25 when we look at that. So that's a look at the S&P 500. The Nasdaq is going to be very similar, of course. When we look at it, the Nasdaq did make it to an all-time high. As you can see, there are those same cycle rhythms that we're looking at right there. And the big move up over here that we saw, my projection was to have a rally to this level over here for 2023. You can see that AI made it much different there. Now we're in this period of this minor cycle correction right now, which we think will likely pull back to 15, we'll just call it 15,500 right there. That's not very far. It's only 1,000 points off of that high, with a chance to get over here at 14.5 right there, approximately 14,500, before it then goes up and takes out the highs. There if AI craze continues, then that level up there is 19,000. I'm going to say that doesn't happen. I'm going to say it pulls back over here, and then we get back up to these levels around 17.2, or a little bit better than that, making a little higher high than it made over here. This was around 16.9. So taking out the highs sometime late in the year or early next year, and then, of course, this much more bearish period out over here in 25 and 26. So again, a cyclical bull market in what we believe is a secular bear market. People are going to ask me for the Dow, so I want to show this to you. And just a reminder that our level 4 members will get all of these charts posted on our chart grid page. And you can see in here the same cycle rhythms and the same expectation that we have. I just don't have the minor cycle projected in here. I have it right down over here. So again, we're looking for a pullback here in the Dow into an area of about 35.7 down to around 34.3, 35.7 to 34.3. And then after that, moving up again, I would expect the Dow to get up between 39.5 and 40,300 sometime late in the year, or maybe even early in 25, before we get into this downside. So this you can see my projection for this little dip right over here. 35.6 to 34.4 is what I have projected right down over here. So the decline should not last very long, and then be coming back up over there. Projected bear market, you can see, into 2026. Went out a lot further than I normally do. Looking at these, it's important. Let me just go back to the S&P 500 here, because one thing that I wanted to show you, in the past I have given the quarterly cycles, and I've shown a chart with the 28-month cycle in there. There's your 28-month cycle right over there, and you can see where it came down here on the 28-month cycle, came down here on the 28-month cycle, where all of these three were coming down. And this is where that happens out into 29 or 30, where that 28-month cycle comes down again. And that's why I really believe that this is a secular bear market, and there will be a number of very large downside moves out ahead. Each of these minor cycles has the possibility of bringing a sharp downside move as we look out over here into 2030.